Hey everybody, welcome to Mortgage Today for Tuesday, October 24th, 2023, and what a day it was. UMBS were down 10 basis points at the start of the morning. Stocks were winning, S&P Futures were up 24.25 points bright and early. Today's only relevant economic data was the S&P Global, formerly Market PMIs. While a bit hotter than expected, these are close enough to contractionary territory, which is anything under 50, that it's not likely to result in a big sustained sell-off or anything like that. Treasuries were steadying after some of the market's most prominent bears warned of an economic slowdown, stoking bets the declines have overshot and that the Federal Reserve will need to lower interest rates. Wild swings in government debt are unsettling investors as a resilient economy makes it hard to work out when the Fed will halt rate hikes. Surging government issuance and geopolitical tensions are also clouding the outlook. There'll be more on that later. We got the S&P Global PMI. Like we said, it came in at 50.9 versus a 49.8 forecast. It was 50.1 previously. S&P Global Manufacturing PMI came in at 50 even on a 49.5 forecast. It was 49.8 previously. We also got billionaire investor Bill Ackman, who wrote a tweet that he had covered his short bets on Treasuries, meaning that he's betting the yields would drop. And Bill Gross of PIMCO fame wrote that he's buying short-dated interest rate futures in speculation of a recession by year-end, so by the end of this year. The 10-year hit 5.02 yesterday and has retreated to 4.84 this morning, which was a big move. I find it interesting that the Atlanta Fed GDP Now model sees 5.4% GDP growth in the third quarter. When you look at the chart where the gray bars are GDP growth, 5.4% GDP growth is exceedingly rare when you look back at the historical record. Home purchases are falling through at the fastest rate since last year at this time, according to Redfin. About 53,000 sales contracts fell through in September, or about 16%. Rising mortgage rates are a big driver, but there are other issues too. Buyers are extra cautious right now. They want to make sure they're getting a good deal given how much mortgage payments have gone up, and when they don't feel they're getting a good deal, they're just backing out. Realtor.com reported that median asking rents fell 0.3% in September, or are down 0.7% year over year, mostly to an influx of new units. Annual completion rates of single families are up 15% year over year. Apartment lists, on the contrary, reported that rents are down 1.2%. It's certainly encouraging to see a modestly positive day for the bond market in the wake of a decent two-day winning streak and despite modestly stronger PMI numbers in the morning. To see the three-day move in the wake of 10-year yields hitting 5+% for the first time since 2007 is perhaps slightly less encouraging. Either way, the market is at least pausing to reflect a little bit here. In other words, there's no immediate plan to stampede up over 5%, but neither do we have confirmation that rates are turning some epic corner in the big picture. At the risk of falling back on the same old thesis, it's data dependent. But MBS did close the day up 22 basis points, ending at 97.19. The Ginnie Maes were up about 20 basis points, actually 19 basis points to be precise. The 10-year closed the day at 4.819. Like I said, it was up at 5.02 at one point yesterday. And our 2 to 10 spread has narrowed considerably. It's now 0.289. It was up around 0.8 about a month or so ago. So ending the day at 97.19, it is putting us right at that 50-day moving average. So we're at least getting back into some technical data, so into some historical trends and things like that, which is nice to see. So we talked about a little bit earlier is about how government debt, spending, wars, and things like that come into play. And there was news that the U.S. has amassed a record $33 trillion in debt with no signs of the deficit spending coming to an end. This means our government will have to issue more treasuries to collect the money needed to run the country. Every couple of weeks, the Treasury sells these bonds. However, the buying appetite has been weak, so the Treasury Department has to pay more yield to attract buyers. Japan and China are the largest foreign countries in the world holding U.S. debt, with close to $1.5 trillion between them. Both countries have been sellers of our bonds as opposed to purchasers of our debt. The reason? Inflation. The U.S. dollar has been strengthening mightily throughout the year, causing foreign currencies to decline in value and making commodities and imports more expensive. China and Japan have been selling some of their vast holdings while using the proceeds to purchase their own currencies to limit the effects of inflation and also prop up their own economy because they're on the verge of a catastrophic meltdown.